Hi everyone, welcome to my channel, All Things Accounting. Today what we're going to be talking about is part one of a two-part series where we're dealing with compound interest. So stay right there and we'll go through this together. So compound interest, what exactly is compound interest? One of my other videos, we were dealing with simple interest. So here, compound interest, how that differs is that interest is going to be earned or computed based upon the outstanding principal amount plus any interest that was owing prior. So let's dive into this a little more, this concept. So usually interest is stated on an annual basis. However, the compounding usually occurs on a much shorter period. So in this case, let's say, for example, if interest is not compounded annually, so in this case, I, which would be the interest rate, if it's not compounded annually, which would normally be simple interest, then it has to be adjusted by dividing this annual rate by the number of compounding periods throughout the year. So let's say, for example, I is equal to 10%, let's say. If interest is compounded semi-annually, then it will have to be divided by 2. If it's compounded quarterly, then it will be divided by 4. If it's compounded monthly, then it will be divided by 12. Now there's 4 different scenarios that we're going to be looking at. We're going to be, in this first part, we will be looking at future value of a single amount. So there will be future value of a single amount, and we'll also be looking at present value of a single amount, as opposed to part 3 and 4, which will be done in part 2 of compound interest, where we'll be dealing with annuities. So in that one, I'll be going through the calculations and formulas and defining what an annuity is. So in here, the first one, the future value of a single amount. Here, what we're talking about, it's an amount accumulated at the future time of a single payment or investment. So here, it's the amount accumulated at a future time from a single payment or investment. So the formula here for that is future value is equal to P multiplied by 1 plus I, the interest rate, to the N, where I is the interest rate and P is the single payment, and N here, that is the compounding periods. Compounding periods. So let's say, for example, ABC company has a $2,000 notes payable that's outstanding with interest, with 10% interest, and that's compounded annually. Now, it's due in 2 years, and upon maturity, what is the future value? So in this case, if we were to apply that formula, so in this case, future value is the 2,000 single payment multiplied by 1 plus 0.10 to the 2. So 2 since it's compounded annually and it's due in 2 years, the number of compounding periods is 2. So this would yield 2,000 multiplied by 1.21 is equal to 2,420. So upon maturity in 2 years, the principal of 2,000 plus $420 would be repaid. So 420 in interest. The next part of this, we are going to examine what is meant by present value of a single amount. So it's an amount at the present time that's equivalent to a payment or investment at a future time. So just to write it all out, it's an amount that at a present time, that is equivalent to a payment or investment to be investment at a future time. Now the formula for this would be present value is equal to the future value, and we're going to be discounting it backwards. That's why we are dividing it by 1 plus interest rate to the n, which is again the compounding period. So just taking like the last example here, same thing, $2,000 notes payable that is going to be due upon 2 years, that's compounded annually with 10%. We can put those figures in and we would have $2,000 all over 1.21, and that would give us 1,652. So if $2,000 was the future amount 2 years from now, if we discount it back based upon 10% and compounding periods of 2 years, this is how much it would be at the present moment, $1,652. So this is compounding interest. I hope you found this to be useful. My next tutorial will be dealing with part 2, which would be annuities, the future and present value of annuities. So I hope you stay tuned for that. So if you like this tutorial and you found it useful, please subscribe to this channel, hit that like button and hit the bell notification icon so that you'll always be up to date on my new tutorials that I'll be posting. Until next time, take care.